Well, welcome. My name is Dave Lerman. Welcome to the CME Group overview of agricultural and FX products. Over the last, like I said, we formed in 1848. The Chicago Board of Trade actually predates the CME Group, but we came together, all these exchanges, and we'll go over the history a little bit here. But in 1848, so about 180 years ago, the Chicago Board of Trade got its start. It got its start because of supply and demand inequalities throughout the world, especially in the United States. Parts of the United States would have an overflow of grains like corn and soybeans. There would be surpluses in certain regions, and in other areas there would be massive shortages. So someone came up with the idea to alleviate this. If people were in great need of soybeans, they can somehow get together in one exchange, in one forum, where people in great need and people with great surplus could get together and buy and sell with each other. As a result, the Board of Trade was formed back in 1848. In 1865, the actual first futures contract was created. Then in 1898, about 40 years later, 50 years later, the CME Group, Chicago Mercantile Exchange, as it was called back then, was formed. And those became, as they ran side by side over the next 100 years, they became the dominant futures exchanges in North America and for most of the world too. But then things, as always, progressed. In 1919, we established the Cme Clearing House. This is critical. The reason why futures contracts and why futures exchanges and the entire industry has so much credibility and has grown so much in the last 150, 180 years is because of the clearinghouse. There has to be a buyer and a seller of last resort. There has to be someone that takes the buyer and takes the seller, matches their trades, and makes sure that payments are paid and collected. Any money made or any money lost in the market from speculating or trading or hedging has to be paid and collected, and the clearinghouse performs this function. So we'll talk more about that later, but that's an incredible function. The CME Clearinghouse is one of the most important benefits of trading futures. Then in 1970s, the first financial futures are launched. Most futures contracts, or almost all futures contracts up to the 1970s, were agricultural in minded, or livestock. So we had cattle futures, live cattle futures, soybean futures, corn futures. But then Milton Friedman and Leo Melamed, who was one of the founding fathers of this exchange, got together and had a little meeting and agreed that why would futures contracts be limited to just livestock or commodities? You can actually turn a futures contract, a foreign currency, into a futures contract. You can turn a treasury note into a futures contract if you wanted to. So in 1972, we launched the first foreign exchange contracts. We had Swiss francs, we had Deutschmarks, we had British pounds. I think we launched 6 currencies back in 1972, and we never looked back. Volume was very slow at the beginning, but then it picked up, and where we are today, when you see the volume charts, you see the growth has been absolutely fantastic. Then in 1992, we launched the first electronic trading system. I remember it. It was in June of 1992. We launched our Globex electronic trading system. The pits can only be open so long. Population of pit traders can only show up during our, the U.S. time zone. They're not going to be here 24/7. They can't do that. They have to get some sleep. They have to have time with their families. But a computer doesn't sleep. So we launched an electronic trading venture called Globex. And now it's interesting, about 90% of our volume used to trade in pits. Now about 90–95% of our volume trades electronically on the Globex matching engine. In 2002, 2008, 2007, after the turn of the century, a series of mergers occurred between the Chicago Mercantile Exchange, the Chicago Board of Trade, and the New York Mercantile Exchange. And as a result, most of the derivative exchanges in the United States came under one roof, under one umbrella, and it's now called CME Group, which was, a moniker off the old Chicago Mercantile Exchange. In 2012, we acquired the Kansas City Board of Trade too, which is they very heavily trade in grains. And in 2014, we did Innovation and Acceleration Lab. So we've been at the forefront of innovation when it comes to the futures industry. So that's an important thing, as the former CEO of Intel once said: either innovate or die. So the CME Group has done a fantastic job of innovating over the last 150, 200 years. And as a result, we're thriving, our products are thriving, and the traders that work with us are also thriving. Some of the most liquid things on the planet are futures instruments. Eurodollar futures, not Euro FX, but Eurodollars, the interest rate contract, is perhaps the most liquid futures contract in the world. It's definitely the most liquid futures contract, probably one of the most liquid financial instruments in the world. You could do a $1 billion notional amount trade and not move the bid-offer spread. And that's the kind of liquidity that traders look at. All right. The third thing is capital efficiencies. When you buy it, like an S&P 500 futures contract, for example, you control an instrument worth about $125,000, yet you only have to put up $5,500 in margin. So you have a good capital efficiency there, and capital is very precious in the markets, and traders want to use the least amount of capital possible. Number 4 is basically 24/7 trading or 24/6 trading. We're not open on Saturdays. One of the great things that traders find about us is they can trade any time of day. They're also a pure direct play on asset classes. In other words, if you want to play the energy markets, people sometimes call us and they say, Dave, what's the best way to play the energy market? Should I do it with ExxonMobil stock or Shell or PetroChina or Schlumberger? And I say, no, the best way to play the crude oil markets is with either Brent crude oil futures or WTI crude oil futures. It's a direct play. If the crude oil goes up $10 a barrel, then you'll make that $10 a barrel on the futures contract. You won't do that if you buy ExxonMobil or the stock or options because ExxonMobil does not move point for point with crude oil. If WTI goes up $1 a barrel, it doesn't mean that ExxonMobil is going to go up. I've seen many cases where crude oil goes up dramatically and ExxonMobil stock goes down because it's a very large company. It's very integrated. That's why it's called an integrated oil company. They have gas stations, they have refinery, they have a chemicals division, and those don't always move lockstep and barrel with the West Texas Intermediate crude oil market. Supply and demand, smoke and mirrors is absent. It's a total supply and demand market. That's all futures are. It's mostly supply and demand. With the stock market, with companies, with corporations, earnings can be manipulated a little bit. You can do various accounting tricks and things like that. And you don't want that. You want a pure supply and demand market, and the stock market doesn't afford you that. In terms of manipulation, you can't manipulate the $5 trillion foreign exchange market. There's no one big enough to do that. And the same thing for the S&P 500. It's about a $25 trillion market cap for the S&P 500 for all of it. And that's a tremendous amount of money. No one person can control that. So you can feel fairly treated in a very competitive environment, but a very fair environment, very trustworthy and credible environment too. The ninth reason why you want to trade futures is that a lot of people, a lot of very prestigious traders with very good long-term track records trade futures. Anyone out there that's a who's who in the futures industry or in the financial industry trades futures or derivatives in one sense or another. Large pension funds, large endowments trade them. The Harvard Endowment, University of Texas Endowment, Yale Endowment, Warren Buffett's Berkshire Hathaway trades derivatives and futures. It's something that if they're trading them and looking at them, you should look at them. And at the very least, if you never trade them, you want to look at them. They're wonderful indicators for how markets are going to open or close and how things are going to go. If you're looking to buy a house or borrow money, you want to look at the treasury market and other markets. So the derivative markets are great indicators.